What's up, you guys? I'm Dan. This is Frugal Not Cheap. A friend of mine recently asked me why I think that day trading is doomed to failure. In today's video, I'll explain why I think so. There's something very alluring about trading for profit, taking a small amount of capital and through, a series of fantastic trades, growing it into a large capital that could set you financially free or maybe just provide income that you need for the year. And this kind of retail day trading has become much more popular lately with the advent of apps like Robinhood and others that have kind of gamified the trading experience and offered commission-free trading as well. However, just like with many money-making opportunities, the majority of people end up losing money. This happens with things like multi-level marketing companies and all kinds of other endeavors where the odds are really stacked against you. If you're interested in MLMs, by the way, I did make a video about that. Now, I'm not saying that MLMs and day trading are in any way comparable, in any way except the odds. I'm just saying that the odds of making a lot of money in MLMs are very, very low. You have to be one of the first. And the odds of being a successful day trader are also very, very low as well. So today's video will be kind of sort of two sections. The first, we'll be looking at those odds. What are the sobering statistics behind day trading? And then second, I'll kind of give some reasons why that might be, looking at all the things that I think are major pitfalls or challenges with day trading. Before all that, a quick note about me and why I know a little bit about these different things. My day job is to run a multi-million-dollar over-the-counter swaps and options book, and I hedge that exposure on the New York Mercantile Exchange using both futures and options. Now, I do not have any kind of licenses regarding securities or investment advice or any of that stuff. And I want to be very clear that none of the following in this video or preceding is any kind of investment advice. These are just my thoughts, the way that I see things, and the way that I go about doing things. So I hope it's entertaining, but do your own research and make up your own mind about things. All right, so what are the statistics behind day trading? Well, one source that I found showed that 40% of day traders quit within just a month. The large majority quit within 2 years, and some 87% have quit by the 3rd year mark. An interesting note here is we know that men are in general larger risk takers than women, and this is reflected in the statistics. It should be no surprise that just over 90% of day traders are men. So how about profitability? So we know that they quit most likely because they weren't profitable, but let's look at some numbers on that. According to a study conducted at the University of California, 87% of day traders, so the vast majority, were unprofitable in a 6-month period. And a separate study shows that 99% of day traders were incapable of producing profitability over a period of 5 years or more. To make matters worse, even amongst this very, very small proportion that were profitable, so like the 13% over a period of 6 months and the 1% or less that were, consistently making money over a period of 5 years, even amongst these, we see that they're underperforming against passive investing. In other words, active traders underperform the index by 6.5% on an annual basis. Now, 6.5% might not sound like a lot to you, but it ends up compounding and being quite a lot. And here we're just talking about retail traders. We're not even talking about professionals. Even professionals have huge rates of failure. One interesting example, and I don't mean to pick on him by any means, this is just, a case study that's indicative of what happens with a lot of other famous traders. We can look at the case of Dr. Michael Burry. So he famously, had Scion Capital and took a short bet against the U.S. housing market. And this paid off handsomely and worked very well and produced huge returns for his investors during the financial crisis. Since that time, however, many of his predictions have come out not to be true, as we can see here in some work that was done by the poster on Reddit. He looked at his sort of public-facing statements made over a period of 15 years following the Great Recession and found that the majority of those things did not come true. Another thing to keep in mind when we look at professional traders is that a lot of times we're looking at trades that are done by someone at a hedge fund or something like that. And in those cases, we might hear about the big sexy trades that did well, but we don't hear about the many lackluster or losing trades that are happening as well. well. And these hedge funds are able to continue to operate even if they're not making the most amazing returns for their clients, because for themselves they're making quite a bit by charging a percentage of assets under management and then also taking a cut of those profits when they do happen. One common sort of pricing structure used to be 2 and 20 or 1 and 20. So they would take 1 or 2% of assets under management and then they would take a large chunk, say 20% of any profits. And again, so far we've been really mostly talking about only an absolute profit or loss. In actuality, we really need to consider also the opportunity cost. And here, generally, that would be investing in sort of some passive strategy, an index. Most managers, about 80%, underperformed against the S&P 500 in 2022. And this was the 12th consecutive year that active managers underperformed the S&P 500. Specifically, we are talking about managed large cap funds. And you can also see that this relationship generally holds true, though, for managed funds for different asset classes or styles compared to the index as well. You can look at all the research at Standard & Poor's website in their SPIVA report. Over the last 15 years, over 92% of these active large cap funds have underperformed the S&P 500. So hopefully we've kind of painted a picture where we can see that statistics for retail traders are horrible. And that should be no surprise because even the statistics for professionals are pretty atrocious themselves as well. All right, so that's the backdrop of kind of like what the results are. But why is this the case? Why is it so hard to be a successful day trader? And by the way, I have tried, doing a little bit of swing trading myself or event-driven trading as well. And you can check out this video for more on that. But here I'll kind of dig into what are some of the kind of common pitfalls and challenges that I've experienced or know about that I see in trading. These are difficulties or challenges that affect both retail traders and fund managers as well. They're relatively universal. The first one is what Warren Buffett essentially called watering your weeds and cutting your flowers. What this means by watering the weeds is holding on to one's losses, one's losing positions. And then cutting your flowers means not letting your gains run. In other words, selling your winners too early. The way that I was first introduced to this idea was sort of in the opposite direction. I was told that I should limit my losses, but let my gains run. So why do we tend to do this? Because obviously it's not a wise idea to limit gains and allow our losses to run. Well, there are really two psychological principles at play here. The first is the sunk cost fallacy. That's the one behind watering the weeds. So once we've taken a loss on something, then we have a psychological pressure once we've made this investment to try to get something out of it, to try to not, to make the most of the situation in some way. And of course, this is a fallacy. So once I've lost on a position, there's really no point throwing good money after bad or holding on to it in some kind of vain hope. If the trade is no good, the trade is no good. And I need to completely eliminate from my psyche that I've made this loss and consider what is the best thing to do at this, at this point. Now, why do traders often not let their gains run? Why do they, jump in and do profit taking early? Well, I think this is due to another psychological problem, which is not problem, but bias, which is loss aversion. In other words, losing $50 hurts a lot more than the sort of pleasure or positive emotion from getting $50. That's called a loss averse risk preference, and one that I think is generally true of humans. And so what that means is that, once we see that we've achieved some measure of profitability, we are more afraid of losing the amount that we've gained than we would take pleasure in sort of gaining more. And so we tend to cut those wins before they have a chance to run as much as they possibly could. So to summarize the impact of what's going on here, we end up basically having larger losses, allowing those losses to be bigger than they should on losing trades. And we end up limiting the amount of gains that we have on our winning trades. And of course, this is not very good for our portfolio. So what's the solution to this? Well, my preferred solution is that I will put a trailing stop. So the way that a stop works generally is, let's say that I'm long on something, then I will put an order that will be triggered if the market price falls to a certain level in order to sell. And then that way I'm able to, limit my losses. And you can think of it vice versa also, if you're short something. But in any case, a trailing stop is going to be moving along with the market. So as the bidder offer on the market is rising, depending on, for short or long, then at some trailing level, I can either set, an absolute trail in terms of dollars or cents, what have you, or I can set a percentage trail, say 10% or 20%. Then the stop will move along with the market, and then if there's a correction, then I can get stopped here and then capture some of my gains. However, here I encounter even more problems associated with the stop loss. So one challenge with the stop loss is setting it properly. In order to find a profitable trade, I might be looking at assets that are either generally quite volatile, because that volatility, of course, is where the trading opportunity comes, or I'm jumping in at a time where there's going to be, or I believe there will be, high volatility as well, in order, again, to profit on this event. What this means is that it's also a bit hard to set the trailing stop. If I set the trail sort of too narrow, then it's very likely that I'm going to get stopped out if there's a momentary blip in the adverse direction on my trade, even if in the long run I'm going to be right on it. So I might set that a little bit wider. But if I set it too wide, then there can be the case where the trade moves into a profitable position, but because the trailing stop is so wide that I'm not able to ever capture that. So we get to this point where the trade is profitable, and then the market moves adversely against me, and I ended up getting stopped out over here. And so I might break even or lose a little bit on a trade that was profitable at one point. So that's very difficult. And again, higher volatility means I'll want to try to set that trail a little bit wider, but then I have an increasing chance of not kind of capturing any gains possibly. If I'm only right on the trade for a little while, or not to a large enough magnitude and what have you. The other problem here, and this is more an issue in the case that I'm wrong about the trade, is in the choice of a stop limit order or a stop market order. We can also think about the problem here as catching a falling knife and the bid-offer spread. So there are two sort of stops that you can put in place. So let's take the case where we're long something. And then we would set a stop to sell the asset if the price were to fall to a certain level, right? So if I set a stop limit order, it'll get triggered when the bid falls down to that level. However, in the case of a market that's falling very, very rapidly, and especially if it's an asset that's not that liquid, which might be something that I chose because less liquid assets could have more opportunity in some cases. In any event, it's possible that the bid might continue to fall so quickly that my limit order won't fill. So that's a pretty crummy situation where my stop didn't really work at all. So then I think, well, what about a stop market order, which, of course, will get filled. But again, the problem here is that, catching a falling knife and the bid-offer spread is that that spread could be quite wide. Again, on a sell stop, we're looking at where the bid is. But also, if the market's moving very, very rapidly downwards, which it likely is in sort of, sell-off scenario where I'm wrong, then even my stop could be here, but it might not get filled, until down here somewhere. And so I could end up eating quite a bit on that. So again, stop losses make sense for me in order to try to limit my losses. However, even setting those properly and using them can be challenging, and they're definitely not perfect mechanisms. There are some challenges. Now we talked about the bid and the offer, and so that spread between the bid and the offer has become an increasingly large concern for the trader. And especially when we talk about the retail trader, with the rise of these sort of commission-free trading platforms like Robinhood and others, because they're not making money on commissions, they have to make it somewhere else. One of those places can be in lending your shares out. That doesn't seem so impactful for our purposes here in terms of trading. But the place where it can be impactful is in terms of the routing of the orders. So payment for order flow and dark pools. And so essentially, what this means is that someone's making money on the trade. So there's a little bit of a spread there that we're losing. And so we're essentially paying a transaction fee in the price that we end up executing at, relative to the price that we might have other executed under a system where we weren't sort of routed through these market makers or dark pools. However, there are still a lot of trades where we still will have to face some transactions costs, and transactions costs are, of course, a hindrance to profitability. The place where the retail trader is most likely to find these are in the higher risk, higher reward type of trades, namely futures and options as well. Any commissions or fees that we have to pay are, of course, going to eat into our profitability. Now, speaking of high risk, high reward, My next topic is that leverage is dangerous. As we talked about at the beginning, one of the most sort of sexy things about trading is taking a small amount of capital and being able to turn that into, a vast fortune. Perhaps without even people really thinking about the fact that this is what they're doing, I think this is one of the reasons that many people are attracted to trading in futures and in options. This is because there's leverage there even if they're not cognizant of it. Let's take the case of a futures trade, for example. When we place that futures trade, some platforms might only charge, a very small fee. If you're trading, full-size futures on the exchange, there is an initial margin. And of course, there'll be maintenance margin as the, price moves either in your favor or away or against. However, this initial margin that you're asked to post is a very small share relative to the value of the underlying. In other words, you can control a lot by putting up only a little. And this is the case for options as well, where, the premium that you pay for the right to buy, for instance, is very small compared to the amount that you'd have to pay in order to buy all of the shares behind that option. This also means, of course, if I'm writing options, then I can lose a tremendous amount. And in futures, I can also lose a tremendous amount if the price is going to move against me. So again, whether or not we were cognizant of it before, trading in these does involve leverage, and because of that, of course, the risks are very, very high. So with these dangers from leverage, of course, that means that I need to set appropriate stops. Sure, we talked about that in the challenges. The other thing that I need to do is be careful about my position size and value at risk. I can, and actually I have had a series of profitable and unprofitable trades where if I had, basically exercised appropriate value at risk and position size management, I could have made a tidy profit. But I ended up making a loss because even though my losing trades had a smaller percentage loss than the percentage gain that I had in my winning trades, because I had more value at risk and a larger position size in the losing trades than the winning trades, then I ended up losing money. So why would I do that? Well, that comes from the next challenge. And this is that wins lead to overconfidence. Over the years, I've been able to, and lucky, to identify a few trading opportunities. However, following these winning trades, I've then become overconfident and jumped into a trade that I shouldn't have had, that I wouldn't have ordinarily had as much confidence in, and then ended up losing money. And because of the overconfidence, I also put more at risk than would have been wise in those situations. Another confounding factor could be that the strategy I used to place the winning trade, those conditions materially changed by the time I went to place the second trade. Or another way to put it is that the strategy I employed on the winning trade worked in the absence of some new factors that were at play that caused the subsequent trade to fail. One way to think about that is that technical analysis and fundamentals don't operate in a vacuum. So I write technical analysis every day at work, and I use technical analysis to help inform some of the swing trades that I did. Again, some of those which were successful and then some of those which were not. But I've definitely found that it does have some predictive capability. And in large part, I think this is the case because other people are also using the technicals. And so they're placing their orders in such a way that, when things happen related to those technical indicators, their orders trigger what have you, or they put in positions. And so technicals end up working because we're kind of all working using that same framework. However, this technical analysis will stop working when fundamentals jump into the picture in a big way. Conversely, we could be trading on fundamentals, some event-driven strategy, but if the technicals are very, very strong in one way, they could either limit the potential of that trade or even, completely overshadow it. So in other words, I need to be cognizant that whatever strategy I'm employing is always going to be fragile to changing circumstances. So that leads me to the next point, which is that trading strategies don't just continue working indefinitely. Markets just change. So there are countless stories of traders who identified some kind of an arbitrage opportunity or sort of a little, you might even think of it as a trick in terms of the order type that they're putting in, or different kind of strategies, some, ethically questionable, but essentially exploiting some kind of a market inefficiency. But of course, what happens is that others will find this market inefficiency as well, and as more and more people jump onto it, then of course it will eliminate that arbitrage window or correct that inefficiency if it's grievous enough. Another thing is some of these tend to be sort of technology driven, and as technology changes, then those opportunities go away. In my time, I started at a time when there was still open outcry trading in the option pits. That of course has gone away, and now it's all electronic. And then subsequently, there was a period where there was really heavy activity in the contracts that I traded, driven by algorithms, sort of, market-making bots, if you will. And even those, given the crazy volatility we've had over the past couple of years following the Russian invasion of Ukraine, then a lot of those have had to pull back because I'm assuming that high volatility was very bad for their profitability, and so they're taking a more cautious approach. With that, there's also been more movement outside of these, very transparent markets, in part because of Dodd-Frank regulations that have become more strict, and so there's been a lot more movement also into over-the-counter markets that are less transparent, a little bit more opaque. But the point is here that my trading strategies will have to adapt over time, and I cannot rely on them to keep working. And they could work very, very well, and I might have a trading strategy that makes small incremental profits consistently for a long time, but then at the point of failure, the losses could be catastrophic and wipe out all of those gains. And finally, I'll say that another problem is that luck is always a factor, or another way to think of it is that uncertainty always exists. So no matter how amazing of a trader I might think that I am, or how dialed in I think that I have the probabilities for different events in this trade, part of it is still going to be down to just pure dumb luck. There's no way to really know exactly what the probabilities are, no way to really know exactly what's going to happen. If it's event-driven trading, I don't really know exactly the way that the market's going to react to the news or the rumor. If it's technical analysis, I don't really know which is going to be the moving average that's going to actually hold support or that's going to, allow a breakout. There's always going to be an element of luck, and my luck will run out at some point. So I think that's a pretty good summary of the pitfalls and challenges that I see to day trading. And of course, if we took a particular strategy, we could zoom in and find a lot more difficulties with that particular strategy as well. But this is just to give a general idea of my thoughts on the matter. But I think we'll end with really the strongest reason that I have for personally not engaging in any kind of day trading activity, or at least not taking it as a sort of serious strategy, right? Maybe just a tiny percentage of my assets in order to have a little fun. And that is that I need to beat the index. So we're back to that opportunity cost as well. So in the end, I could get lucky and I could put in all this work and I could make some, returns, but it's going to be pretty meaningless if I can't consistently and over a long period of time, we're talking years here, be able to beat the returns from passive investing. And they're not negligible. On average, we're talking about nominal returns from a passive investment strategy of maybe about 11%. And it's very, very hard to beat that. So that's the framework that I use to think about day trading for myself. Did I miss any big day trading mistakes that you can think of? Let us know in the comments below. Hope you found today's video helpful. If you did, please hit the like button and consider subscribing. Thank you very much for watching, and I will see you in the next video.